$100 billion in reported revenue. America's most innovative company, 6 years running. And a shocking amount of that success was, in the end, pure fiction. The trick was almost elegant. Book tomorrow's imagined profit as today's cash, then quietly slide the leftover debt into companies nobody would ever think to question. The stock soared all the way to about $90. Then a few stubborn people started asking how the money actually worked, and it fell to 26 cents, the largest bankruptcy America had ever seen. Executives convicted, a giant accounting firm destroyed, thousands of pensions gone. So how did the smartest guys in the room end up here? Rewind. In 1985, two thoroughly unglamorous pipeline companies merged into one and called it Enron. Its business was gloriously boring, moving natural gas through steel tubes buried across America and charging for the privilege. But its chairman, Kenneth Lay, had no interest in running tubes. He wanted Enron to be the world's leading energy company. And pipelines, whatever their charms, are simply not a stock that investors fall in love with. So Enron reinvented itself as a trader. Instead of merely shipping gas, it would buy and sell contracts on the future price of energy itself, part sleepy utility, part fast-talking Wall Street bank. Wall Street adored the makeover. The dull old pipeline had become a fast, clever, modern machine, and the stock began a long and deeply satisfying climb upward. Suddenly, everyone wanted a piece. Fortune magazine agreed, enthusiastically. It named Enron America's most innovative company, not once, but for 6 straight years, from 1996 to 2001. Business schools taught it as the future. There was only one small, awkward question nobody seemed to want to ask underneath all that applause. Where exactly was all of this money actually coming from? Here is the trick that made Enron look magical. It is called mark-to-market accounting, and Jeff Skilling built the entire company around it. On paper, it turned patience into an instant jackpot. Say, Enron signs a 20-year deal to deliver natural gas. Normally, you would count that money the boring, honest way, as it actually arrives year after year after year. Mark to market let Enron do something far bolder. Estimate all 20 years of profit up front, decide what the deal might eventually be worth, and book that entire imagined total as income today. The deal might earn nothing for years. On the books, it was already a triumph. Sign a contract and profit appears instantly, which is a wonderful feeling right up until the actual bill arrives. So reported profit and actual cash quietly drifted apart. One line soared confidently toward the sky. The other barely managed to leave the ground. Guess which one the magazines put on the cover? And once your profit is really just a forecast, you can afford to forecast generously. Every quarter needed a bigger, braver, rounder number than the one before it. The guesses simply had to keep growing. By the year 2000, it was working spectacularly. Enron reported around $100 billion in revenue and stood among the very largest companies in America, 7th on the Fortune 500 list. The stock hit roughly $90 a share. On paper, the company was worth tens of billions, and its executives were treated less like managers and more like visionaries of a whole new economy. The idea became intoxicating. Build a trading floor, the thinking went, and Enron could trade almost anything: natural gas, electricity, internet bandwidth, advertising space, and famously, even the weather. The culture matched the swagger. Rank every employee, fire the bottom slice each year, and reward the biggest numbers above all. Confidence was not a side effect of Enron. Confidence was the actual product. Banks lent freely, analysts cheered, and the press swooned. The smartest guys in the room were, understandably, very happy to keep agreeing with that flattering description of themselves. But a company that books imaginary profit still receives extremely real bills. And the ever-widening gap between the glorious story and the actual cash had to go somewhere quiet. somewhere hidden. Where it went was down a trapdoor, one designed and operated by Enron's chief financial officer, a man named Andrew Fastow. This is the point where the story gets genuinely, unsettlingly creative. Fastow built a sprawling maze of partnerships and shell companies with cryptic, almost villainous names: LJM, Chuco, the Raptors. On paper, each one was carefully kept separate from Enron itself. Into those entities, Enron quietly shoveled its debt and its losses. The parent company's balance sheet stayed clean, calm, and gloriously profitable, exactly the way Wall Street liked to see it. It was financial sleight of hand on an enormous scale. The debt did not actually disappear. It simply stepped off camera into companies that most Enron investors never even knew existed. And the very man who designed the trapdoor also helped run the partnerships waiting on the other side of it, where prosecutors later said he personally pocketed tens of millions of dollars. For a while, the whole hidden machine stayed perfectly balanced. It had just one simple, non-negotiable requirement to keep working. The stock had to keep going up, forever, no exceptions. In March 2001, a Fortune reporter named Bethany McLean asked a dangerously simple question in print. How exactly does Enron actually make its money? Almost nobody could give a straight answer. It was a very fair question. Enron's financial statements read like a fog, hundreds of dense, footnoted pages that somehow never quite explained where the enormous reported profits were actually coming from. Then, in August 2001, Chief Executive Jeff Skilling abruptly quit after just 6 months in the top job, citing personal reasons. When the self-described smartest guy suddenly leaves the room, people tend to notice. Inside the company, an executive named Sharon Watkins wrote privately to Ken Lay. She warned in writing that Enron might implode in a wave of accounting scandals. She turned out to be exactly right. Publicly, Lay kept reassuring everyone that the future was bright and the stock was a bargain. Around the same time, some insiders were quietly selling shares of their own supposedly miraculous company. Employees, meanwhile, were still being encouraged to hold their Enron stock and even to buy more of it. The numbers, unfortunately, were about to disagree with all that optimism, very loudly. On October 16, 2001, Enron reported a surprise loss of $618 million in a single quarter. For a company that only ever seemed to produce record profits, that was a genuine shock. In the very same breath, it quietly erased about $1.2 billion from its own shareholder equity. The trapdoor Fastow had built was finally, audibly, creaking open for everyone to hear. Regulators started asking pointed questions. Then Enron restated years of past earnings, formally admitting that profits it had already announced and celebrated were, on closer inspection, not really profits at all. Confidence is the only thing holding a trading company together, and Enron's evaporated almost overnight. Credit ratings dropped, lenders panicked, and the trading partners who were its lifeblood backed nervously away. A smaller rival, Dinnigy, briefly agreed to buy the wreckage and save the day. Then it opened the books, saw exactly what was hiding inside, and walked straight back out. There was no rescue coming. On December 2, 2001, Enron filed for bankruptcy. With about $63 billion in assets, it was the largest corporate collapse America had ever seen. The most innovative company had innovated itself to zero. The stock that had once traded near $90 ended at around 26 cents. Tens of billions of dollars in value simply ceased to exist on paper and in reality in a little over a year. But the cruelest blow landed squarely on the employees. Many of them had their entire retirement savings packed with Enron stock, encouraged to buy it, praised for their loyalty, and sometimes even locked in. Roughly 5,600 people lost their jobs almost immediately, and an estimated $2 billion in employee pension savings was wiped out along with the company. Loyalty, it turned out, was not rewarded. And Enron's own staff were not its only victims. A year earlier, its energy traders had been busy playing elaborate games with the entire state of California's electricity supply. Documents released later revealed trading strategies with actual cartoon villain names: Death Star, Get Shorty, Ricochet. They were used to exploit a very real power crisis and shove electricity prices higher and higher. Federal investigators found that Enron had overcharged Western customers by an estimated $1.1 billion. The trading floor's famous cleverness, it turned out, had a real body count, measured in blackouts. As federal investigators finally closed in, Enron's accountant, Arthur Anderson, one of the 5 biggest audit firms on the entire planet, began quietly feeding boxes of documents straight into the shredder. Anderson was convicted of obstruction of justice in 2002 and collapsed, taking tens of thousands of its own innocent employees down with it. A higher court later overturned that verdict, far too late to matter. Congress responded with the Sarbanes-Oxley Act of 2002, forcing much tougher rules on how public companies keep their books and on the auditors who are paid, at least in theory, to check them. Then came the reckoning for the men at the very top. Kenneth Lay and Jeff Skilling were both charged with conspiracy and fraud, and after years of appeals and delays, the case finally went to a jury. In 2006, that jury convicted Ken Lay on all 6 counts he faced, and Jeff Skilling on 19. The smartest guys in the room were now, officially and legally, convicted fraudsters. Lay died that summer, before he could be sentenced, and his conviction was formally vacated. Skilling was sentenced to more than 24 years in prison. Fasto, who cooperated with prosecutors, served about 6. Enron did not collapse because it made a bad product. It collapsed because it slowly, confidently confused a brilliant story about profit with the far less glamorous business of actually having any. The lesson outlived the company. Reported earnings are not the same thing as cash. An award is not an audit. And debt you have cleverly hidden inside a shell company is still, stubbornly, your debt. That was Enron, a company that got so good at telling the story of money that it genuinely forgot to keep any. For more true stories of fortunes made and lost, stick around.